Drawing trend lines is something nearly all traders try to do in order to identify past and previous trends. Despite this, drawing trend lines remains hard to do for many traders. This is due to the fact that many traders have different conditions when it comes to considering if a trend line is valid. When this is the case, inconsistent trend lines are made, making the chart extremely cluttered and unclear. All of this causes for confusion and incorrect trend lines, making it likely that entries will be made into losing positions. In order to avoid all of these problems, we can use an indicator that removes the elements of subjectivity, providing a clear and concise view of the trend, and allowing traders to enter into profitable positions by filtering out the guesswork and noise in the market. The indicator we are talking about is the market bias indicator. The market bias indicator is a powerful indicator that offers traders an objective and reliable approach to trend identification. Let's first add this indicator to the chart. Head over to the Indicator Search tab and search for the market bias indicator. Select the indicator made by Professor X and add it to the chart. This is the market bias indicator. This is an indicator that helps to determine the market bias and the overall direction of the market, using a combination of moving averages and smoothed Heikin Ashi candlesticks. Along with this, there are different colors that are plotted on the market bias ribbon. Let's now take a look at and change the indicator settings. Navigate to the Indicator Settings tab and click on the Input tab. The first setting we can see is the period setting. The period refers to the length or duration over which the indicator calculates its values. It determines the number of data points considered in the calculations, thereby influencing the sensitivity and responsiveness of the indicator to price fluctuations. As you can see, by increasing the period value, the sensitivity of the indicator is lowered, showing us a longer-term view of the market bias. On the other hand, when the length is decreased, the indicator becomes more sensitive to changes in the price action, causing the indicator to show a shorter-term market bias. Since we want to decrease the sensitivity and see stronger and longer-term trends, we will be changing this setting to 150. Next, let's discuss the smoothing setting of the market bias indicator. The smoothing value determines the degree of smoothness applied to the indicator's calculations. It acts as a filter to reduce noise and provide a clearer representation of the underlying trend. A higher smoothing value, such as 200, would result in a smoother indicator line, reducing short-term fluctuations and noise. Keep in mind that while this means that the indicator will provide a clearer view of the market bias, it causes for the indicator to become less reactive, making the reading it provides less precise. Conversely, a lower smoothing value, such as 20, will provide a more responsive indicator line, capturing faster changes in price action at the cost of increasing the noise that is displayed by the indicator. A good middle ground for the smoothing is 50, showing us a smooth and clear view of the trend without including too much noise. The final setting of the market bias indicator is the oscillator period. The oscillator period determines the length over which the indicator calculates the oscillating values, which indicate the strength of the trend. By adjusting the oscillator period, traders can fine-tune the sensitivity of the indicator to market fluctuations. A shorter oscillator period, such as 3, will generate more frequent signals and respond quickly to price changes. Conversely, a longer oscillator period, such as 30, would provide smoother and less frequent signals, capturing broader market trends. Since we are looking for a middle ground, we will be keeping the oscillator value at its default value of 7. Now that we have properly configured the input settings, let's navigate to the style settings. Here we will be removing the Heikin Ashi candlesticks, since the line already reflects the value of the Heikin Ashi candlesticks, making them redundant. That was all that we needed to do. It's first important to understand how the indicator can be read. We can first look at the position of the market bias line and compare it to the price action. When the line is above the price action, it indicates that the trend is bearish or likely to switch to bearish. However, if the price is trading above the market bias line, it indicates that the trend is bullish or likely to switch to bullish. The second component we should look at is the market bias line color. It's obvious that whenever the line is green, it indicates that the trend is bullish, and whenever the line is red, it indicates that the trend is bearish. However, what exactly do these dark green and dark red colors mean? Well, when the market bias line is light green, it indicates that the market is in a stronger bullish trend. An example of when this would be the case is if a bullish breakout occurs. On the other hand, a darker green color indicates that the bullish trend is weak. An example of when this would be the case is if a pullback or correction is made. When the market is in a bearish trend, the indicator will display either a dark red or light red color. When the color of the indicator is light red, it shows us that the bearish trend is stronger. This could occur, for instance, when a significant bearish breakout takes place, indicating strong selling pressure. Conversely, when the market bias indicator displays a darker red color, it suggests a weaker bearish trend. This might happen during a pullback or temporary consolidation within an overall downtrend. Now that we know how the indicator can be read, let's take a look at the different methods of using the indicator. Besides the regular method for reading the indicator, which involves looking at its colors, the Heikin-Ashi calculations in the market bias indicator can also be utilized as support or resistance levels. As you can see, it often happens that pullbacks are made to the market bias line before heading back in the bullish direction. The same goes for bearish trends. There are many instances where the price pulls back up to the market bias line before heading back down in the bearish direction. A different method for reading the indicator that can be used to spot and avoid ranging or consolidating markets involves looking at the width of the market bias line. As you can see, the indicator line becomes wider when the market is consolidating. This can help us spot and avoid these consolidating and ranging phases in the market. Conversely, the market bias line will be thinner when the price is heavily trending. By looking at the width of the market bias line, we can easily determine whether the market is trending or not. Because of the wider lines indicating consolidating or ranging periods, it's also likely for support and resistance zones or order blocks to be present at these price levels, since these can form during tight ranges. By adding two market bias indicators to the chart, each with different settings, we can see both the short and long-term trend. In this case, one of the indicators has a period value of 200 with the rest of the settings at default. The other indicator has a period of 20 and a smoothing value of 20, with the oscillator period using default settings. As you can see, by applying two of these indicators to the chart, we can see both the short and long-term trends, allowing us to enter into positions when both the short-term and the long-term trends align. In this case, both the longer-term bias was bullish, and along with this the short-term bias just switched to bullish, indicating that there is bullish sentiment for the long-term and short-term trend, making it likely that the price will move in the upward direction after this signal. If we take a look at the price action, we can see that this was indeed the case. Despite the indicator already being very powerful, we will be adding some extra indicators to the chart in order to create a full strategy that utilizes the indicator. Head over to the Indicator Search tab and search for the Range Filter indicator. Select the indicator made by TFEN and add it to the chart. The next indicator we will be adding to the chart is the Volume indicator. Search for the Volume indicator and select the indicator made by TradingView. Those were all of the indicators that we will be adding to the chart. Now let's change the indicator settings. First, navigate to the Range Filter indicator settings and click on the Style tab. We will be removing the high target, low target, bar colors, and all other elements except for the buy and sell labels. Now let's head over to the Volume indicator settings. Click on the Inputs tab. Here we will be changing the length of the moving average to 35. Once you have done that, click on the Style tab in order to enable the moving average. Make sure to also change its color to make it more visible. In order to enter into positions, by combining these indicators we will be using the following method. First, we will be determining the dominant trend with the market bias indicator. Next, we will use the Range Filter indicator to determine the exact point at which we will enter into the position. Finally, to confirm that there is enough volume in the market, we will be using the Volume indicator as the final confirmation. Let's take a look at entries that can be made by following this method. Here we can see that the market bias line is green, indicating a bullish trend. However, upon closer examination of the market bias line, we notice that it's currently displaying a shade of dark green, suggesting that the bullish trend is relatively weak at the moment. Analyzing the price action, we observed that after a significant upward movement, the price experienced a pullback, which explains why the market bias indicator was indicating a weaker bullish trend. This pullback serves as a natural reaction to the bullish surge, creating a correction, causing for a temporary pause in the market's upward momentum. It is through this lens that we interpret the darker shade of green in the market bias indicator. To gather more insights, we turn our attention to the range filter indicator, which also issued a buy signal, reinforcing the notion that the range filter is currently bullish. This additional signal aligns with our previous observations, further supporting the idea that the market has the potential to resume its upward trajectory. Moreover, we noticed that the point at which the price began to reverse its direction had previously acted as both a support and resistance level. This historical significance lends more weight to the current price movement and suggests that the market sentiment could favor a continuation of the bullish trend. Finally, if we take a look at the bars that were displayed on the volume indicator, we can see that they exhibit a bullish pattern sentiment and are positioned above the moving average. This observation underscores the presence of a significant amount of bullish volume in the market, indicating that there is enough buying pressure to potentially push the price higher. By combining all of these signals, we can conclude that it's a good idea to enter into a buy position. To manage our risk, we will be placing the stop loss at the recent swing low, aiming to limit potential losses in case the market doesn't follow our anticipated trajectory. For the take profit level, we will adopt a risk-to-reward ratio of 2-to-1, seeking to secure a reward that is twice the amount we are risking. This approach allows us to maintain a favorable risk-reward balance. Now let's take a look at how the trade plays out. Here we can see the following: the dominant trend in the market switched from bearish to bullish. After the switch was made, the price made a pullback back to the market bias line. However, while the price was making lower lows, we can see that the market bias line was still green and moving in the upward direction. After the pullback, the range filter produces a buy signal, providing confluence with the signal provided by the market bias line. The final signal that confirms the previous signals provided by the market bias and range filter indicator is provided by the volume indicator. We can see that the volume indicator is indicating that there is enough bullish volume in the market due to the bar being taller than the moving average. Because of these signals, let's enter into the buy position here. We will be placing the stop loss at the recent swing low. For the take profit, we will be targeting a 2 times risk-to-reward ratio. Now let's see how the trade plays out. In this case, we can see that the price was in a large downtrend, characterized by the lower lows that were being made. We can see here that a temporary pause occurred in the downtrend because of the price making a pullback to the market bias line. This is confirmed by the dark red plot that was made while the pause was playing out. It's also important to note that the market bias line is wider, making it likely for it to provide more resistance. After the pullback, a large red candlestick was plotted, indicating that the bearish trend is likely to resume. We can also see that a bearish sell signal was plotted on this large bearish candlestick by the range filter indicator. The price action also provides a bearish indication due to the double top that was made here. Finally, if we look at the volume indicator, we can see that there is a large amount of bearish volume present in the market because the red volume bar is taller than the moving average. All of these signals indicate that it's a good idea to enter into a position, so let's enter into the sell position here. To manage the risk, we'll be placing the stop loss at the recent swing low. For the take profit, we'll target a 2 times risk-to-reward ratio. Now let's see how the trade plays out. The market bias indicator can also be combined with premium indicators such as the Lux Algo signals and overlays package. As you can see, despite the range filter providing profitable signals, the Lux Algo buy and sell signals are a lot more accurate and are better at following the trend. If you are interested in getting access to the Lux Algo premium indicators, check out the link in the description to get them with a 30-day money-back guarantee. I hope you now fully understand how the market bias indicator works and how it can be used or integrated into your own strategies. If you enjoyed the video, please leave a like and subscribe to the channel.